unicorn valuation or $1 billion valuation is not necessarily something that has to be achieved before an IPO. You can very well achieve that after being a listed company, right?
Hi everyone. In this episode, I get a chance to speak with Vikram Gawande. Vikram was previously the co-founder of Urban Pro and is currently the director of growth investments at Blume. In this episode, we discuss the emotional gap between founders and VCs. Since Vikram has been on both sides of the table, he was able to share like a very nuanced view of like what it takes to be like a good investor. Vikram also challenges this idea that startups should wait until they hit like $1 billion valuation and only then start thinking about going public. The benefits surrounding that and the incentives around that. We also discuss how do founders create personal wealth as well, either through secondary sales or post-IPO block deals, basically liquidity events. So broadly, in general, if you're looking for like a grounded long-term perspective on building and exiting companies, I feel like this conversation should be really helpful for you. With that, my friends, Vikram Gawande.
So you've been on the founding side of the startup ecosystem and also in the investment side or in the ecosystem as well, being an active participant on both the sides, which I feel is a valuable, which is I feel is a valuable experience and brings with it a lot of knowledge as well. I wanted to start off with, could you talk about how being a founder has kind of impacted or influences the decisions that you make as an investor? If you can maybe start on that, maybe we can pick up from there.
Sure. So I think being an entrepreneur and then becoming an investor, more than the skill, the biggest thing that it helps you is to build empathy towards the founders, because it's very simple to say, for instance, is that reduce these costs, right? Or why this has not happened. But when you are in the founder seat, you know how difficult it is to cut costs, especially like, let's say, reducing headcount, right? Like me being in the driver's seat when COVID happened and you had to rationalize the cost, you know how hard it is to let people go off, right? So hence, when you are having those conversations with founders, you can have a rational conversation wherein, of course, like there is a business need and there is the reality. So that's on the softer aspect of it. In terms of when you are looking at the business, there are certain nuances of the business which you are able to assess better. So for example, when you are looking at a team, you're talking with a team, things which are non business, you are able to assess whether, for instance, like today I would be conducting CXO level interviews for my investee companies, right? You would be better able to assess is that whether this guy would be able to gel into the culture, whether he would be a long term player, and so on. So essentially, what it is coming down to is that what does it take to build a large franchise is not just about numbers, but beyond numbers as well. I think that's the lens which gets strengthened if you have been a founder. And of course, like if you are assessing something in a domain that you have already built something in, that is, of course, you know it to some extent better in terms of what works, what doesn't work.
What would you say is easier? Like, I mean, because you've been on both sides, is being a founder a more difficult job than being an investor? And could you like maybe paint a picture of like why it may be easier or difficult?
So I think again, like whichever side I say, like somebody is gonna like me, somebody is not gonna like me. But this is my personal point of view. I think being a founder is surely difficult because it's his or her only baby that they are working on. So day and night they're working on it. And especially mission driven founders for whom the mission that they're working on is paramount. Like even when capital is not there, even when people are not there, they're just working relentlessly on it. The number of sacrifices that they would have made or are making to make it happen is just something that is unimaginable, right? I mean, you run this podcast, and I think this is something that you would have given up on so many things just because you are passionate about it, right? I would put you into the entrepreneur bucket. If you look at on the investor side, I think we would be, of course, like we would worry about our positions. We would be as much wedded into the entrepreneur success as the entrepreneur is. But to be very realistic over here, like we would also be working with multiple startups, right? So a portfolio of ours in every fund would be like 30, 35 companies per se, within which some would be stars, some would be in the middle, and some would not be able to make the cut per se. That's the reality of venture. It works on power law. So, like, to cut it short, like, I think the entrepreneur's journey is more difficult. People, of course, from outside see like it's the company was able to raise hundreds of millions of dollars, X valuation, Y valuation. Some company went IPO at $1 billion and so on. But all these are just, I think, milestones. It's a journey, because somebody who is looking to build a multi-decadal, multi-generational company, there are ups and downs, and we have seen it in multiple even listed players. Like, if you look at Eternal or Zomato, it had its highs, it had its lows. The stock plummeted after listing to like sub 50 rupees, if I'm not wrong. Now it is a darling of the street. So the founder has to go through all these pieces.
In terms of role, is there a particular role that you think is like very well suited for a VC role, in the sense that like your personal background is, let's say you were a founder? Are there other roles, like say whether you were like an operator, or whether you were I don't know, marketer, or even journalists have known to like break into the industry? Is there a particular role which is not a VC, but if you have that background, it makes it much better to either evaluate or talk to people? Or is there a role like that you think?
So if I understand your question is, what are the backgrounds that are well suited to be a VC,
That makes more sense, yeah.
right? I think there is no one standard answer for it. Let me give you the answer in a different way, wherein what different backgrounds could do in the VC setup, right? And VC I'm using very loosely right now. It could be early stage, growth stage, and so on and so forth. So if you look at it like journalists, like the famous folks at Sequoia, where their background was in journalism, right? A big part of venture is about storytelling, because when you are funding a company for the first time, there's no revenue. Many times there's no product. You're backing the guy in a large space. And when this guy wants to raise next rounds of capital, or when you want to tell this to the external world, be it LPs or other your colleagues in the investment world, it's a story, it's a narrative. Sometimes the founder does it phenomenally well. Sometimes you have to coach the founder to do it, right? So that's the storytelling aspect, right? Then there are guys who come from product slash tech background. I'm coupling product and tech for a moment over here. Those guys bring in a different kind of expertise to work along with the entrepreneurs, or to evaluate companies from their product richness or the way they are thinking about their tech stack. Tech stack becomes more important if you're building enterprise tech companies per se, right? So that's the second aspect. The third is people who have been into consulting roles, investment banking roles, and so on, who automatically come with macro views or are data centric and so on. They have their own advantages when evaluating companies, especially when it comes to companies with little bit numbers and so on, so series A onwards. And then the fourth bucket is operators, which you could club with entrepreneurs as well. They would mostly have seen the entire gamut of the game, right? Hence, they would be suited for that part of assessing companies. But when it comes to the finance aspect of it or the fundraising aspect, they might learn on the job per se. So each part that I talked about, these four buckets, bring in different expertise. Other parts probably they would learn on the job. And you would see the same in Indian VC ecosystem as well, or even in our fund itself. Like, people come from diverse backgrounds, have different strengths, and the other pieces that they would have probably built on the job.
So maybe a weird question, but if you were optimizing to make like the maximum money, like would you rather advise an early like young graduate to get into like a VC fund, or like in the investment space, as opposed to like founding a company or joining an early stage startup? Like what are your thoughts there?
So this is a great question, and I think this is a question that often youngsters or like freshly grad or few years of experience guys do ask. I think my advice to them is that, what is your calling, right? What is your eventual goal? If your eventual goal is that you want to build a multi-generational company, you know it. Now, the only path you can take is that you can start right now itself. Now, that company may work, may not work. It has its own probability, right? But that even if the first venture of yours fails, it doesn't mean that you can't build a large company. In India also, now you have got second generation, third generation founders who are trying to build larger. Like, first company was exited for sub $100 million. Now the second one, they are thinking they would build a multi-billion company, right? So that's one path to be an entrepreneur. Second is you work in some startup or some scaled up company and you reach there. There is also a crop people who come to VC and they get exposure to various fields, how VCs evaluate, and they enter entrepreneurship, right? And the second crop is people who say that no, I don't want to be an entrepreneur, but I want to have exposure to multiple startups. For them, the investment world is amazing. But I think at the end of the day, it lies what is the real calling. And I mean, there is a famous book which you also would have read called Ikigai, like what these three things should intersect, like what you like, what the world wants, what the world wants to pay. If you had to ask, like, if both people were successful, if it is just about money, right? If an entrepreneur is crazily successful, a VC is crazily successful, I think the chances are that the entrepreneur would create larger sums of wealth compared to a VC. But it has its own probability, right? It's not an easy path. Like, the pyramid of seed to an IPO, it's like a steep pyramid in terms of successful companies.
I think on my understanding would be, I think on average, the average investor probably would make more money in their lifetime, but maybe the outlier of founders might make like really outsized return. Is that fair?
Depends. Like, again, investor is a very loosely coupled thing, right? If you take the entire gamut of VCs to public markets, and there would be failures, etc., etc. I don't know. There is not an exact math that is available because, like, which GP made how much money, it's not available per se. Of course, this is all off record. I don't want this to be quoted, but it could be like, if one does the math, that average of VC outcome, I think, would be still lower than average of companies which are Series A plus funded, because the value of death is really at Series A. Beyond that, it decreases.
I see that. That's very interesting, actually. So you're saying till Series A is where there is a life and death moment, but and you're saying it's difficult for a company to like go extinct after Series.
The value of death is A. Beyond A, if you've crossed that chasm, I think the probability of success increases. You could find out, because I think only 25% of seed funded companies make to A. So you see that is the biggest chunk where drop off would happen.
Just to like maybe dig a little deeper there. I mean, the reasons are maybe because you see some paths to like you have like decent amount of revenue that you can see a clear path forward. Is that the logic? Is that the reasoning, or am I missing something?
No revenue, like A's, you wouldn't have significant revenue. So the classic definition of A is a Series A round happening is that you have a product market fit and you have signs of revenue. Just that you can monetize. There are signs, the exact is not available. B is when revenue is proven. Now it is that you raise capital just to scale. That's the colloquial language of rounds. But now, I mean, A, B's, everything is mixed. The rounds are just a function of first when was the round raised. But if you look at the literature meaning of A and B, this is what it is.
When we are talking about value creation, and I think you have mentioned this in multiple articles as well, which I will try to link in the description. One of the major things that gets spoken about is like the unicorn route or building a unicorn. Could you maybe talk about, is that a fair ambition for, is that the only ambition slash fair ambition for a founder who is getting into building his own startup to have? Or if not, can you show some other ways or how you would think about this?
So I think the term unicorn, the history when it was quoted and so on. I wouldn't get into those details, but I think why it has become important for the founder is that that's a term that is very commonly used, right? And my philosophy is that, or rather, even all of us at Bloom think, is that the unicorn valuation or $1 billion valuation in Indian terms, let's say 9,000 crores, is not necessarily something that has to be achieved before an IPO. You can very well achieve that after being a listed company, right? You've seen that in companies like India Mart. You've seen that in companies like, I think, Blackbuck also now is about $1 billion. And multiple such companies which listed between this, Ixigo also, like, which listed at 3,000, 4,000 crores and then went up, right? India Mart is, I think, about 1.7, $1.8 billion now. And I think it has been a phenomenal compounding journey. So the founder having an ambition to be a $1 billion company, I think that's perfectly fine, right? But the point that I want to list only at a $1 billion valuation, nothing below that, is something I believe is a flawed argument. The reason why I say it is flawed is if you are a profitable company, I'm saying profitable because Indian public markets expect the company to be a bit profitable, not by law, but just its expectation. In 2020, 21, 22, during the heydays, when those 4, 5 IPOs, large tech IPOs happened, people were fine with not having the EBITDA. But now the market again wants EBITDA, like even your urban company had EBITDA, right? So now if you are a EBITDA profitable company, you don't need capital to grow because you yourself are throwing out cash, and once you throw out cash, debt is automatically available. Why don't you go and list? The fact is that in the private markets, your cost of capital is far higher because the expected IRR or expected return on capital for a private investor is north of 25-30%, right? The cost of capital on public markets is lower because there, if you even if you give a return of between 15 to 20%, the markets are happy. If you give 20% plus, you are amazing, right? Because if you look at the best public market funds over a decade, what have they given? 16-17% probably, right? If you look at my portfolio also, like a mutual fund, if you look at over 10-15 years, it wouldn't have compounded more than that. Like if you look at Nifty also, it has compounded less than 15%, right? Over last 10 years, 20 years. Last 5 years, I don't count because it's a short period. So now, if that is the case, even if a company lists at 3,000, 4,000 crores and then compounds, there's no problem. And in fact, if you list at that point in time, you've got a liquid stock. With that liquid stock, your founders are happy, employees are happy because they have liquid stock, because they are one of the stakeholders. Your investors are happy because they have got liquid stock. Your banks are more happier to lend to public companies rather than private companies because it's liquid stock again. Your vendors also feel more comfortable that this is a listed company. So your entire set of stakeholders is happy. You can go and acquire a company with your this stock better than a private company. So everything is falling in place. Of course, two things you need to have in place for sure is that one is you need to have a predictable PNL for any time for 8 quarters going ahead. If you don't have that, don't go and list. That's not the advice that anybody should go and list, because public markets quarter after quarter would look at what you had told us, what is the guidance you gave us, and where are you. If you are meeting that or exceeding that, markets are happy, right? So that's one. Second is that you need to be comfortable that you are gonna be at the helm of the company for at least medium term per se. Of course, there have been cases wherein the original founder moved out as in he moved to an executive director, a non-executive director role, and a CEO came in, and so on and so forth. That can happen, but you need to be convinced that I want this company to run for next multiple decades per se, right? So if those are ticked, the value creation piece is here is that the company compounds. If you grow at 20-30% also in the markets, you would be worshipped like anything. Everybody creates capital. And oh, by the way, if you are consistently outperforming or meeting the guidance that you've given, your stock gets re-rated. What it means is that if you listed at, let's say, a multiple of 20 times your earnings, right, hypothetically, if you consistently do it, do the performance that you have told about, it could move to 25 as well. Over like 3-4 years, it could move to 30 as well. So that's the benefit for everyone, that if you have predictable PNLs, if you are here to learn it for the longer journey, go and listen.
So because you said that so passionately, I mean, I'm also wondering, one is like, why are people or companies not doing that today? And do you see that changing in today's times? Like, do you have any thoughts on that?
No, so I think it is, why does it not? Now let me take the investor hat for a moment, right? The investor mechanism works is that I have a let's say $100 fund. Through this $100 fund, I might have invested into 30 companies, right? Now these 30 companies have to return at least 400 rupees to me, because like 4x is a good fund. Of course, like in the US, you go like 7, 8, 10 baggers are the best funds, right? But I'm taking a median fund of let's say 4x. Now for 400 to be generated, and let's say your residual ownership is 5%, right? Now you do 400, as in that becomes 8,000. 400 into 20 is 8,000, right? Now 8,000 market cap has to be captured. Now replace all these 100, 200, everything with crores. Or if you replace with million, it's further funny, right? This becomes 8 bill. If you have 100 million, it has to be 8 billion market cap has to be created. If my residual ownership is 5%, how would that happen? Because out of 30 companies, only 5 companies probably are going to be able to generate that 4x DPI. The remaining companies might generate 1 point, like zero point 0.5 or so. So 3.5x on my fund is going to come from 5 companies.
Mm-hmm.
Let's make it simple. Let's say 4x is going to come from 4 companies, right? So now you divide that 8 billion by 4. So every company's market cap has to be $2 billion for me to return a 4x fund. Now, but here the variables are few. I said 5% residual ownership. If
Sorry,
my residual
what is residual ownership? I'm not clear with that.
residual ownership as in my shareholding in that company. So why I did that 20 is that 1 by 5% is 20x. So when I do 1 by 20, that's 5% ownership, right? So I just multiplied that 400 by 20. So now if my ownership is 10% at the end of the journey, instead of $2 billion, I need $1 billion, right? Now that $1 billion, now you could cross question me that, so which means that $1 billion listing is required, hence proven, right? But the reality is that no investor can sell the entire of his stock immediately after listing, right? Because you take an average VC funded company in this country. I'm saying average because there are exceptions. So 70% of the cap table is owned by investors. An average IPO, when it happens, the max secondary sale that might happen is, let's say, 20%. Not by law, but general trends I'm telling. So now if you say this entire thing is sold by investors, still 50% ownership is remaining to be sold. So let's say there is Ryan Private Limited. Ryan Private Limited, I own 70% in your company. You're going IPO. The max probably I would be able to sell only 20% of the 70%. Still 50% is remaining, right? Now, this 50% cannot be sold just going in the open market and selling it, because the stock price would crash. So it has to be sold in a very structured fashion, which are called block deals. You would have heard in newspapers that there are block deals. Now, if this 50% has to be sold in block deals, and those block deals, by the way, start after 6 months. So there is a lock in period of 6 months, anyways. Typically, it would take about 3 to 4 years for this entire 50% to come down to zero. But at the same time, Ryan Private Limited, which has become a public limited company now, it would keep on compounding. Na? Like today, if your revenue is $100 million, next year probably you would do 130, then you would do 170, and so on and so forth. So your performance is improving. So your valuation is not going to stay. Let's say if you list at $600 million, it's not going to stay 600. You're going to go to 800 billion, point 2 billion, point 5, and so on. Hence, over a period of time, your weighted average would generally be above $1 billion. This is what we believe. But of course, like if a company has raised capital at last round, private round at $1 billion plus, chances of they listing at a billion less than $1 billion are low. So that's where now capital efficiency, ownership, etc., all these things come into play.
So two slight digressions maybe. So my understanding is that, again, I don't know how true this is. Like my understanding is that most of the value creation, at least for companies, happens after listing. But my understanding is also that generally VC firms or early investors do sell most of their stake, either because of, I don't know, fund closure, or for various reasons they might have to sell most, if not all, of their shares, maybe post listing. I don't know, like famous example I can think of is like Peter Thiel, like offloading most of his Facebook shares post IPO. And I think even Google, I think Sequoia also offloaded a lot of Google shares post IPO, but which ended up compounding later on. Is my analysis correct? And is this what is also practiced in like Indian ecosystem, where once the company lists, VC firms generally like maybe sell most of their holdings for various reasons?
No, so there is again no one straight answer to it. It's a function of what is your exit strategy. People have different exit strategies. Like some US funds have made it public. Most of the guys don't talk about it, but it would be fair to assume that people have a strategy wherein they would sell some part of their holding before the IPO, which is pre-IPO or whatever happens. They would sell some part in the IPO, and they would sell the remaining part over a period of time after the IPO, right? Now, in the after the IPO period, why they don't hold it for perpetuity per se? There are some funds who hold it for perpetuity, by the way. Like they have created separate vehicles in which they are held for perpetuity and so on. Let's not get into that. But you're right, like every fund has a tenure. Like in India, we everybody runs an AIF per se. AIFs are 10 plus 2 years, which is 12 years, or different structures which they tell at the time of their setting up the fund, right? So you are governed by that, and you have to liquidate at various points in time. I mean, said that, of course, like you can request for extensions, etc. But there is a time period over which you need to do that. The other piece is that the people who have given money to venture funds, these are large institutions, and the capital that we have got is for venture capital strategy, not for public strategy. For public strategy, they have a different pool. So, for example, the same company, Ryan Public Limited Company, like earlier Blume was holding it. Now they could go and buy in the public markets, no, directly on whichever broker they are dealing with. So they don't need Bloom for that. So, in terms of why the money was given, it also comes into.
Another small digression is like you also mentioned that Indian markets in general want companies which are EBITDA profitable or profitable in general, and if you do not have that, it's difficult. Do you have any thoughts on if that is like good for the country or good for the economy per se? Like I'm contrasting this to the US market, where I think when Tesla listed, it didn't have any revenues. I think Tesla listed in 2012. I think up until 2019, it didn't have any profits. It was not profitable. Even I can think of Amazon as well. I think took about a decade for them to become profitable, but they ended up listing as. Any thoughts on like why we don't have that risk appetite? Do you see that changing? Any general thoughts on that?
No, I wouldn't have any thoughts there, because this is a market expectation. As I said, it's not a law. Like in fact, like we have different filing mechanism, like called 6.1 and 6.2. One of them is for profit making companies. One of them is for loss making companies. So the law does allow for it. Just that the consumer expectations are that a company has to be profitable, EBITDA profitable, just to be precise.
In terms of liquidity for a founder and for their employees, and is how should they think about it? Like if not IPO, is there something that they can how should they plan out their maybe liquidity events? Are there some metrics that they can maybe keep track of while they're building the company, and also discuss those with employees per se? Is there a plan for that, or is selling the IPO route the only way to kind of go about this in terms of liquidity for them and their employees?
Yeah, so like I think this is a bit nuanced question. Like liquidity also comes with a question of for what, right? I think investors have been comfortable to facilitate liquidity for founders if it comes to their basic needs, right? For example, if somebody wants some liquidity to buy a home or so on, investors have been comfortable facilitating that. Of course, like I wouldn't say that at a seed round per se, but beyond A's, which is like B's and so on, investors have been comfortable. Employees, again, that is a function of how the founder looks at it. But ESOP buybacks and so on, that you would have read it in multiple cases that have been common. Because what also starts happening is that a company which turns profitable or is not guzzling in cash wants to raise a round. They don't want a lot of primary capital because it's dilutive. For example, like if a Series B round is being priced at $100 million, the company would say, I don't want to raise more than $20 million in primary capital because I don't want to liquidate more than 16%. But now this 20 million is providing the new incoming investor only 16%, 16.66 to be little bit around 20% rather. Now this investor wants a higher ownership. So what is the way to get it? It's so secondary. Now in secondary, angels could sell it, founders could sell it, some employees could sell it. This is very common in the market. The third thing, which is also happening very commonly, is that companies which are on IPO track, not done IPO yet, their stock is very liquid, right? So, for example, last year, I think Lenskart, more than $500 million of stock was traded in the market, which was all secondary. Similarly, in our portfolio company, Purple, more than $100 million of stock was traded all secondary. So, this becomes a very, like, once a company is on IPO track, the liquidity levels go up very high even 2 years before the IPO.
Are you seeing a lot more companies either interested in doing an IPO over the past few years, at least maybe, if you compare that to, let's say, a decade later, a decade before that, or are you seeing a trend of companies wishing to stay private longer due to like a lot of capital in the private markets?
I would like to believe that more companies are going the IPO path because, like, I think we published a report last year around the state of public market IPOs over decades period. I think our timestamp ended in September 24. We haven't refreshed it. But by that time, about 350 IPOs were done in the country on the main board. I'm not talking SM. And as far as I remember, since then till now, about 80 IPOs have happened. So, what happened in almost a decade, one fourth of that has happened just in a year, which is talking about the velocity of IPOs in the market. So, of course, IPOs come in windows. So right now, it's a strong window where there is a strong appetite for pricing and taking IPOs. So that's happening. But I think more and more companies are thinking, or more and more founders are thinking about building IPO-able companies, which is great for the economy because, especially like from tech-enabled or tech-first companies, there are very few companies. Like we have about 40 odd companies which are listed, which are tech companies. I'm not talking IT services and tech. These are like product first companies, right? Be it Eternal, be it a Swiggy, or be it a Ether, and so on. So those kind of VC backed or PE backed tech companies, there are only about 40 listed companies. And the good part for investors over there is that probably these companies growth rate is faster than rest of the market.
We spoke about liquidity for founders. I don't know if you mentioned this or if you answered this already. But do you have any thoughts on liquidity for investors as well? Like in the sense that, is there a dance that you have to maintain between like selling at, like, is it better for investors to kind of sell their position early on during secondaries in the earlier rounds per se, or like waiting up till the IPO? Is there a dance that happens there, and what are the incentives?
Yeah, no, like everybody would want to sell at the highest price, right? But what is the highest price? Nobody knows. But you surely have a rough math on. This is a company which is, like, again taking the example of Ryan Limited, is that $100 million revenue at listing. We think that this company can grow from $100 million to $130 million, and hence for like 130, if it goes to 160 at that point in time, even if the company is valued, let's say, at 5 times of their revenue, it would be about $800 million. And today it's at $500 million. So basically, like, can I hold it till then and sell my remaining part then? So there is some science that goes behind it. But would an investor hold on to everything for post IPO sale? I don't know. Like if you are a strategic investor coming from balance sheet, maybe yes. But if you are a VC fund wherein money you are holding money from your LPs, I think people would mostly take some chips off the table before the IPO. Everybody again has a different strategy. I'm caveating that out.
Fair enough. Over the past 5 years, what do you think has changed the most in terms of like the startup ecosystem? What surprised you the most?
Over the last 5 years, I think the basic input for the startup ecosystem, or the basic ingredient, is founders, right? The quality of founders has gone up immensely high, not just over 5 years. Like I started my VC career in 2011, so which is almost 15 years ago. I think the quality of entrepreneurs, and hence the solutions that they are coming up for problems that exist in India and globally, that has gone up crazily high. Like I'm super duper happy about it and continue to be bullish about it. The second thing that has happened is that we would have never imagined of anything beyond B2B services that is being built out of India, but the SaaS revolution told that even products, global products could be built out of India, right? You look at a Freshwork, you look at a Postman, or even in our portfolio, there would be multiple companies like Lambda Test, Grey Orange, and so on, which are building for global markets from India. The biggest thing which I wouldn't have thought of like 5 years ago is consumer products for the world being built out of India. For instance, we have a company called Ultrahuman, which is building a wellness ecosystem for the world from India, which is phenomenal. And like I think multiple investors have various companies which are building consumer products for the world from India, which is very interesting. On the public market front, I think historically the average age of a company when it got listed was about 20 to 23 years, right? That's the historical last decade number. But increasingly, what we are seeing is that even younger companies are going IPO faster. If you look at Cure Foods, which is, I think, going for an IPO this year or so, their age is only 5 years. Same for Ola Electric as well. So, a lot of companies which started building 5 years ago are just going and wanting to ring the bell, which is very interesting phenomenon because that also changes the way exit horizons change and hence how investors look at it. Yeah, so those are few things.
Sorry, I just want to go back to liquidity, and it's a slightly a weird question, I think. Is it fair to say, and we'll come back to this, is it fair to say for a founder, IPO is definitely like the last or the ultimate exit event per se, or like a very epochal event in their journey of building a company? But in terms of like near term liquidity, in the sense that if I'm a founder, I'll obviously take a massive pay cut when I start the company, and even for like a decent amount of time, I may not be paid market standard. Are secondaries a decent way to look at like a good amount of liquidity, maybe at AB, where even though not from monthly salary point of view, but at least a one time like outlier event per se? Is that a fair thing to kind of assume?
Yeah, so like the way I read you is that can a founder think of some liquidity to take care of his basic needs? Like I'm talking about a house because that's the costliest event in your life. And like, can he take that level of liquidity? The answer is yes. The only thing that I would say is that your business is working in the right direction. So let's play it out. Like you are raising a small bridge before your next round of 10 crores, right? And out of that, if you say that I want 3 crores of liquidity for my personal needs, that may not be the best case, right? However, you are raising a full fledged round which is of 100 crores. And within that, you say that 2 crores, 3 crores, whatever are needed for my personal needs. I think that's more digestible. That's the context I think in which it would work.
So ideally, the bigger the round that you're
So
able
I
to
gave round
raise,
size as an example, but it's also what is the capital requirement of your business? Of course, round size does help, but what is the capital requirement of your business? Right? If in the same 100 crore example, if you needed 100 crores to be used for capex and that is being some money is getting pulled out of it, that may not also work, right? So let me put it this way: is like after taking care of what is required for your business, if there is a surplus demand, that can be used for founder liquidity at a certain point in time.
makes sense. Thank you for that. Going back to you mentioned that the quality of founders has definitely increased over the past 15 years since you've been in the system. Do you have particular reasons for that? Is it just experience? Is it capital? Any reason that you think?
No, I think the ecosystem has matured. People have like you would have heard of this term mafias, right? Also people have got exposure, have worked in these product companies, right? Today there are like probably more than 100 large companies, tech companies that exist in the country, and founders would have worked at these companies, would have seen scale, would have solved for real problems. So that surely helps, and then that percolates down. So even people who come out of fresh out of schools, they are passionate enough, they have done good amount of homework in that space, and there is more openness on the other side of the ecosystem as well. So for example, in our portfolio there's a company called Pixel, right, which is a satellite company with hyperspectral cameras. These are guys fresh out of Bits Pilani. They got funded, and like they have a 9 satellites up in the air. Their ages would be like 23, 24. Now at that age, being able to do that, of course you need guidance. So they have got some phenomenal scientists, ex ISRO and so on, who have been working with them, helping them. So there is also the ecosystem who is helping these great founders, and then the ecosystems part is also investors who are there to fund great crazy ideas from great founders.
So if you were starting a company today, knowing what you know, knowing what you know, if you were starting a company today, what advice would you give for somebody who's looking to start? AI is pretty hot. Are there any sectors that you think are underrated or appreciated, or nobody's working in the sectors?
No, I wouldn't comment on the sector. The only thing I would say is that go and solve a problem that you are passionate about. Like, do a startup only if you are passionate about it, because there are gonna be good days and there are gonna be bad days. So put yourself for a moment thinking that the next 1 year is a bad day. Would you still be doing this, what you are stepping onto? Not just because AI is hot, or D2C is hot, or SaaS is hot, or there is money available in XYZ sector, I would do it. People might disagree with this point of view, but I firmly believe is that missionary founders are driven by the mission that they are chasing. And that's where great companies get created, wherein the company outlives the founder. Of course companies outlive the investors because investors are there for a stipulated period of time only, but companies outlive founders when they are really mission built and so on. Like we have so many examples in front of us wherein so many companies got funded in 21, 22, great founders, but probably they came into that because capital is available and not because they were wanting to solve some problem that they were passionate about.
What is the most difficult part of being an investor for you personally?
The most difficult part of being an investor on the entrepreneur side is saying no to an entrepreneur for sure. And then because you have a fiduciary responsibility, it's not difficult part, but it's a you have to be very vigilant about is you have a fiduciary responsibility to your LP to return capital, and hence very closely being looking at the exit path for your portfolio, because at one end you are funding something which is phenomenal, but at the other end of the spectrum you also have to think about how is this going to generate liquidity or going to generate return. So you need to have a fine balance of both these things.
I think on that note, Vikram, thank you so much for taking the time. I really appreciate it.